Hi everyone, since a lot of you are asking me to create a video on how do you evaluate a startup in your work profile, here I am creating a detailed video on the same. So just to give you a disclaimer, I am not an expert in this field. It's been only 1 month that I've joined this VC fund of Aditya Birla Ventures, and based on my last 1 month's experience and interacting with a lot of startup founders on a day-to-day basis, I'm just going to share some of my learnings. So, first of all, what we check before investing in any startup is the background of the founder. Like any company, any VC or any investor will check what is the background of the founder. It's better to invest in the person rather than the product. Of course, the product is going to matter, but before that, you invest in the person. So you check the qualifications, you check the credentials, you check the past work experience, you check the other co-founders, other team members, and after that you also check whether he has started something of his own previously or shut it down and then he's moving on to his new venture. So trust me, like even if he's a failed entrepreneur, then that's absolutely alright. In fact, that also shows that he must have learned a lot of things in his previous venture, and now before moving on to his next venture, he can apply the same learnings and not going to repeat the same mistakes which he has done in the previous venture. So that is seen as a positive sign. But of course, the background and credentials and qualification, that is very, very important. The next thing is that you check the business model and the unit economics of that startup. So it's like the problem which the startup is solving and what is the solution, whether there is already one startup which is existing in the market, and if there's a startup which is existing in the market, what additional things that this startup can provide in order to do better from all the other competitors. So let me give a very simple example. So Zepto came in the market in order to disrupt the entire market with the 10 minutes delivery concept. So what happened was that companies like Swiggy, Grofers or Big Basket, they used to deliver the groceries, but it used to take them at least like 1 day's time in order to deliver to the destination. So what did Zepto do? It came into the market. There were competitors in this field already, but it disrupted because of the fact that it introduced the concept of dark stores. So what it is doing is that in every 3 kilometer of radius, it has some dark stores where it is keeping all the groceries, and if there's any person who's ordering the groceries, it'll deliver the grocery within 10 to 15 minutes of time after the order is placed. So how are they able to do this? Because there's a dark store in every 3 kilometer. Let's say in Mumbai, I'm staying in Worli right now. Okay, so if I'm ordering something within 3 kilometer of radius, there will be a dark store where all the groceries would be stored, and the relevant person will just take 60 seconds in order to pack them once the order is received, because everything is ready in that dark store, and that person will just take 10 minutes because it's a radius of 3 kilometers. So if I am staying here and if the dark store is somewhere around here, so yahan se 3 kilometer ke radius mein every area is going to get covered. So I think that this is a business model which they have adopted. They disrupted the entire market share because of the fact that they had this idea of 10 minutes grocery delivery. So they interacted with a lot of consumers in Mumbai. They also took a customer survey and they understood that people want groceries in 10 to 15 minutes. And once they understood this, they disrupted the entire market. Now even companies like Swiggy and Big Basket, they have also started introducing this 10 minutes delivery concept, but Zepto just disrupted this entire market. So even if a startup is entering in a field where already 3-4 players are there, it's not that the startup is not going to survive. If it's coming with something unique proposition, some value proposition which is going to be there, then that is going to disrupt the entire market. So that is the second thing which we look at. The next thing is the pitch deck which the startup founder is going to present you, in which all the unit economics, all the competitors and everything is going to be mentioned. So like a startup founder has to create a pitch deck of let's say 15 to 20 slides where the entire background of the company, founders, business model, problem, solution, competitors, everything is given. So usually the pitch deck starts with the problem and the solution. What is the problem which the startup is solving and what is the solution of this problem? Then the TAM is mentioned. So TAM is what? Target addressable market. So target addressable market is nothing but the total market size in India. So the question is, how do you calculate the target addressable market? So target addressable market is very simple. You just have to multiply the revenue by the number of customers existing in the market. So for instance, if there's any edtech company which is catering to students from 1st grade to 12th grade, you just calculate the number of students in India from grade 1 to grade 12 and multiply by your product price. So this is the target addressable market size. So any pitch deck will have problem, solution, then the target addressable market. And in fact, in one of the articles which I was reading in Forbes, an entrepreneur had stated that for any VC to get excited, the TAM should be minimum $1 billion, which is 7,500 crore rupees. Then only the VC is going to get excited in order to invest in a startup. The next thing which is mentioned in the pitch deck is the revenue monetization plan. So for example, if it is a pre-revenue model where the startup has not even started charging all the customers, but it is going to charge in the future. So that is a pre-revenue phase. You have to check what is the monetization plans in the future. So for instance, taking the same example of Zepto. So as of now, there's no revenue for Zepto because it's like it is just making the users habitual to that application. And once we are habitual to that app, our mindset is going to be that even if it charges, let's say 20-25 rupees of delivery, we are going to pay because we are used to buying it from that app and we are used to getting the grocery deliveries for 10 minutes. And that is the thing which Zepto is doing. So as of now, it's not getting any revenues, but the future source of monetization streams are so high, they can charge some delivery fees to the customers, which the customers can pay. Or apart from that, maybe they can just add some amount of margin on the product which they are selling, or they can just place any advertisement on their applications if any company wants to place. So there are so many monetization streams for them. And as of now, it's a pre-revenue product. So even if it's a pre-revenue product with zero revenues, you have to understand what are the future revenue monetization streams before investing in any startup. That is important. And one more thing which is covered in the pitch deck is the go-to-market strategy. What is your customer sourcing strategy? How are you going to acquire your future customers? So as you know that it's very important to acquire your first 1,000 set of customers, because these first 1,000 set of customers are going to be your advertisement channel, because they are going to refer your product to other people and then other people are going to buy. So the best way in order to grow organically is by acquiring the first 1,000 users and making them completely satisfied so that they are going to refer your startup or refer your product to any other person. That is also very important. And then in pitch deck, you get the competitor slide where you also understand about the other competitors and you have to ask them about how do you differentiate your product with other competitors. So for instance, Zepto can say that it differentiates from Swiggy, Grofers, Big Basket in terms of it is able to deliver it in 10 minutes with the concept of dark stores. So these are some of the questions which are already answered in the pitch deck. And finally, you check the unit economics, because the unit economics need to be viable. So unit economics means what? It's nothing but a profit and loss account of a startup. Since it's a startup, you won't get the entire detailed P&L as per Ind AS or AS. What they prepare is the normal revenues and costs. So there's a concept of CM1, CM2, CM3, which is contribution margin 1, 2 and 3. So CM1 is what? After deducting their direct operating costs. CM2 is after deducting their marketing and selling costs. And CM3, which is contribution margin 3, this is nothing but after deducting their all other indirect expenses as well. So this is about the CM1, 2 and 3. And we also check the LTV to CAC ratio. So LTV is what? Lifetime value, and CAC is nothing but customer acquisition cost. Usually in any industry, the LTV to CAC ratio should be around 3 to 4x. So your lifetime value should be 3 or 4 times the customer acquisition cost. And lifetime value is nothing but कि ये customer तुम्हारे पास कितने साल या कितने महीने तक रहेगा multiplied by the revenue which I'm going to get from this customer. So all these concepts are very simple. You just have to check all these multiples and ratios the way you check all the ratios like current ratio, quick ratio, profit margins, gross margins, revenue growth while investing in stock markets. So it's like when you're investing in startup, you have to see these figures like CM1, CM2, CM3, then LTV to CAC ratio, what is the amount of customer acquisition cost, whether it's very high as compared to the revenue which you are earning from that customer, what is the payback period in terms of if your customer acquisition cost is let's say rupees 100 or 200, how much time will it take for you to earn rupees 200 from the same customer. For example, companies like IND Money are paying hell lot of money to all the influencers on Instagram, even on YouTube. So for instance, if they are paying 1 lakh to an influencer who gets 1 lakh views on his reels, the customer acquisition cost here, assuming that out of 1 lakh people, अगर 1 लाख लोग वो रील देखते हैं, उसमें से अगर 1% लोग भी वो IND Money का प्रोडक्ट यूज करने लग गए, तो क्या हो जाएगा कि 1000 लोगों ने वो प्रोडक्ट यूज किया, तो कस्टमर एक्विजिशन कॉस्ट कितना हो गया? 1 lakh rupees given to that influencer upon 1000, which is 100 rupees. So 100 rupees का acquisition cost है. Then how much time will IND Money take to recover 100 rupees from this customer is another metric which you should check. So I'm giving you easy examples so that you can understand what is this LTV, CAC and what is the payback period, so that you also have that mindset in terms of how do you evaluate any startup. This is also very important. Then there's a concept of cash burn which is asked to all these founders. So cash burn is nothing but what is the amount of cash you're burning on marketing spend, selling spend, on your employees, etc. So lower cash burn rate is always preferred because you need to ensure that the money which is going to be funded by a venture capital fund, that needs to go to the right place. And I think that the lower the cash burn rate, it is better for the VC fund because you are managing your fundings in the most efficient manner. Of course, even a higher cash burn rate is okay, but you should be able to justify to the VC in terms of what is your relevant or what is the purpose of burning this much amount of cash. So that is very important. So this is cash burn. Next, which is one of the most important things, is the valuation front. So now how do you value any startup? Okay, so you can use the DCF method, which is there like discounted cash flows, in terms of just projecting the revenues, asking the founder what are your assumptions and just doing a normal DCF. Other thing is the transaction comparables, where you evaluate what is the relevant multiple which other companies in the same space were acquired at or were invested in. So for example, if Sequoia Capital or Lightspeed or Matrix, these VC funds have invested at let's say 4x, 5x multiple of revenue or 10x, 20x multiple of revenue on other deals, you have to check what is the multiple you're giving to this same startup in the same field. So usually the startups are traded at a multiple of ARR. So what is ARR? It is annual recurring revenue. Annual recurring revenue is nothing but your revenue for the entire 12 months, and it's calculated very simple. Usually all the founders, what they do is that the previous month's revenue, they multiply it by 12 in order to get this annual recurring revenue. Because क्या होता है कि जैसे last month का revenue लेंगे वो सबसे ज़्यादा होगा, and once they multiply that by 12, the ARR figure would be higher, and higher the ARR figure, higher would be the amount of valuation applying the same multiple on the ARR figure. So usually startups are valued at ARR multiples. So again, it depends. In SaaS space, so software as a service category, वहाँ पे multiple would be 30x, 40x of revenue. In some other cases, let's say a D2C companies, they're direct to consumer, which is into e-commerce or which is into fashion commerce. The multiple there would be like 6 to 10x of revenue, or the multiple there might be 3 or 4x as well of revenue. So it depends upon which industry you're serving in. And this is again one of the most important discussions which comes between a VC and a startup founder in terms of what is the amount of valuation. So these are some of the things which you have to keep in mind before investing in any startup, or even if you're a startup founder, these are some of the things you have to keep in mind, like having a proper pitch deck, then convincing the VC about what is the proposition, what is the value prop, the competitors. If there's a global unicorn in the same space, you have to show them the case study of how this global unicorn rose and how you're also able to become a unicorn by comparing or maybe by getting inspiration from all these global companies. So that is again a relevant business model which we evaluate in terms of investing in any startup. So if there's a comparable across the globe, like if there's a company which has become a unicorn in this segment, then we'll also have some confidence that okay, even if it is replicating that company, it can turn out something better and it can just do something better in order to become a unicorn. And the last thing which any VC will check before investing is that what is it you are needing this huge amount for. So for instance, if all these startups which are raising, let's say $5 million, $10 million, $50, $60 million in their Series A, pre-Series A, seed rounds, then a VC needs to have that comfort that why is it that he's needing $5 million round of funding as of now. Like the founder has to convince that he needs it for, let's say, employing more people, spending more on tech, spending more on marketing, etc. And then once the VC is convinced, it is going to give this amount of money. So I know there were a lot of technical jargons in this video like LTV, CAC, ARR, valuations, etc. But trust me, I have given so many examples in order for you to understand it in a very simple manner. And you know what, just wanted to ask you one thing. So it's like I'm going to create videos on these topics now. So let's say like you want to understand what is a seed round, Series A round, or let's say you want to understand what is the business model of this startup, or you want to understand some other metrics like MAU, DAU, which is monthly active users, daily active users, etc. So just help me with this in the comment section, whether you want to hear to some global business model of startups, whether you want to listen to some models of, let's say, Indian unicorns. There are 83 unicorns in India as of now when I'm making this video. And if you want me to create videos on, let's say, each and every unicorn, what is their business model, I'll be more than happy to do that. Or let's say you want me to interview some startup founder, entrepreneur, or let's say some partner from a good VC. So I can also understand what are these VCs looking for before investing in any startup, and you also understand what is it happening. So just wanted your opinion in terms of what do you want to see. I've given 3-4 options now. So just help me by writing in the comment section what topics you want me to create videos on. And trust me, just once you mention the relevant topics in the comment section, I'll try my best in order to create more videos on these kind of topics. And I think that this is a category which is not covered by any other person, like just creating videos on business models of global startups which has become unicorn. So that is a niche which I think I can just go ahead with. But trust me, like if you are interested to watch that, then only I'll create videos on those topics. So just help me with this and just comment below what are some of the topics related to entrepreneurship or startup phase which you would like me to create videos on. So thank you so much guys for watching this video. I know this was a detailed video, but I'm sure you might have understood what do we look in order to invest in any startup before investing in any startup, and this is definitely going to help all of you. So thank you so much for watching this video. See you in the next video.